My name is Michael McLean. I am the founder, managing member for Left Coast Healthcare Advisors, and this is our first time here as a sponsor. Thank you for having us. It's been a great conference. Hopefully we have the opportunity to come here again. Just a quick introduction to ourselves. So we are a strategic development, operations, and management firm. We focus on healthcare consulting. I started the business about 2.5 years ago. We're a team of operators. We're a little different than other consulting firms. And I started it after 25 years of working in healthcare space, seeing the same problem, whether it was me as a hospitalist PA or a CEO, even in my time at Providence, working with all the ambulatory facilities, kept seeing the same problem. There's no shortage of consultants that tell you what to do. If you need to build a new facility, add a practice, hire a doc, build a hospital, build an ASC, and there's certainly no shortage of people to do it for you in exchange for some capital or maybe a lot of equity or a management fee. There's just not a lot of people to help you do it and to tell you how to do it. And that's how we were formed. We spend our time helping you take your strategy, how to do it. Whether it's picking the right physicians, how do you move from strategy to execution, sitting with designers and builders and helping you optimize that operational space, making sure your facility is the right size, working on reimbursement strategy to make sure you can really lever the benefit of that new facility, or putting operational teams in your facility with your people, helping identify what processes have to change so that you can actually execute the strategy. That's what we do every single day. We're your advisor, and we take our name, Left Coast Healthcare Advisors, seriously. We're all here, we're Seattle-based, and even though we work up and down the West Coast, we think of ourselves as your partner, and we think we're a little different. But enough about us. I'm here to introduce Grant. So Grant Shaver, principal with the state and local taxes with Clark Nuber. He's gonna dazzle us with tax discussions here for our next session. So Grant, I'm gonna give you a chance to come up here, and just a quick reminder that if you need CPE credit, don't forget to sign in on the iPad in the back of the room. So Grant, all yours.
Thanks, Michael. Good news for me, bad news, or bad news for me, good news for you. John, I came in during his presentation and was like, wow, this is gonna be a really hard act to follow. Taxes right after a story as inspirational as the one that he shared will be quite a juxtaposition. The good news is for you, I couldn't feel more inspired right now than after hearing that presentation. So that will hopefully carry through into an equally inspirational topic of state taxes. My name is Grant Shaver. I'm a principal in state and local tax at Clark Nuber. We're a full-service accounting firm that provides professional services in accounting, audit and review and tax services, and software implementation. We're headquartered in Bellevue, actually just walking distance from here. We're a regional firm, about 350 employees. So it's April 17th, Thursday. Hopefully it's not news to you that your federal taxes were due on Tuesday, April 15th. If it is, I'm sorry to have to be the one to tell you. We're here today to talk about state taxes, not federal taxes. So if you had to file a If you had to file a Washington state tax return on Tuesday, it was a capital gains tax return, which meant that you had over $270,000 of capital gains last year, which probably felt pretty painful to you at a 7% rate. But I'll tip my hat to you and say congratulations on a good year with that much capital gains. It's an exciting time to be alive, or that's one viewpoint of it. There's so much happening at a federal level as far as political, social, economic changes go. Similarly, in Washington, we're seeing a lot of interesting things happening during this legislative session. This is a 105-day session for the state legislature. It ends in 10 days on April 27th if they don't extend it. They're setting the budget for the next biennium, so July 1st, 2025 through June 30th, 2027. And they're looking at a shortfall. We've got a lot more spending happening at the state level. So there needs to be more revenue generating activity, and there's a lot of different opinions about how we're going to raise that revenue and what the best way to do that is. We've got a new governor in office who has strong opinions, and we're going to talk a little bit more about what's happening there. I've got an update based on a budget proposal that came out yesterday, and we'll cover that towards the end of the presentation. We should have plenty of time to get you out, maybe even a little bit early for lunch, and then have Q&A at the end. There's also a lot of interesting things happening from like a judicial perspective in Washington right now, going to a different branch of government. We've got two Washington State Supreme Court cases over the past couple years, which changed perspectives and paradigms within the tax community. One was Antio and related to how investment income is taxed in Washington. We're going to talk in detail about that. The other case was Quinn, which was a challenge to the Washington state capital gains tax. We're going to unpack a little bit more of some of the state constitutional limitations around having an income tax in Washington and talk about how the capital gains tax was enacted and how the Washington State Supreme Court came to the decision that that was not an income tax. Michael, this might be your phone. Okay, great. His Amazon package just got delivered. My specific area of technical focus is indirect taxes within state and local tax. So I don't do any income tax work. We don't have a state income tax in Washington, technically. I do a lot of work with B&O tax and then multi-state sales and use taxes. So that's where more of the focus on today's conversation will be. Starting off here. So there was a audit done of a group of 16 LLCs in Washington that were affiliated with each other, and they were buying and selling distressed debt instruments like credit card debt. And they were making their revenue, I believe 100%, from those activities. And Washington has had a long-standing deduction for investment income that is earned by businesses. It's been around since, I think, the 1930s, and there was some, it was the subject of some debate in the 80s and 90s. There were two cases, Simpson and O'Leary, where the Washington State Supreme Court looked at what qualified as investment income. And in 2002, there was a legislative fix in response to the Simpson case that said basically any investment income earned by entities that are not financial institutions, and they went on to describe what a financial institution is, and other security businesses, that income would be wholly deductible for Washington B&O tax purposes. So that's been the status quo for the last almost 25 years. Enter Antio. The Department of Revenue does an audit and says, well, 100% of your income is earned from these investment activities. That's not really investment activities then, because investment activities that are the topic of this deduction that exists are only activities that are incidental to the primary business purpose of the entity. So then there was this debate about whether the ruling in this 1986 Washington Supreme Court case O'Leary, where they came up with this definition of incidental investment income, and that being the only thing that's deductible, whether that still applied to the statute that was rewritten in 2002. And ultimately, the Washington State Supreme Court decided that it did apply and was not overruled as a part of the legislative fix in 2002. So this all comes up in a legislative session year where we're facing a budget shortfall, which isn't great timing for taxpayers. From the one perspective, this is like kind of a windfall to the legislature in a way for them, without having to pass potentially unpopular and controversial new tax law, a way to get additional revenue. There's been a lot of questions about what the exceptions to this would be. The Department of Revenue has put out a 5% safe harbor. It's the safe harbor that they used in the Antio audit. That said, they said in the Antio case that because over 5% of your income is earned from investment activities, this is now, they say, the main business purpose of the entity, but I think it should say a main business purpose of the entity that's subject to B&O tax. So they released information on their website, informal guidance, that said there would be this 5% safe harbor, which doesn't mean that if you're above 5% of total gross receipts from investment activities that they wouldn't still qualify for deduction. But in my professional experience, when there is a test like that out there, it is fairly uncommon for the department to find exceptions to a test, even if it's not a bright line test, or one that is like a hard and fast rule. But there are some deductions that currently exist. So there's the 5% safe harbor. There's also a deduction for endowment income in another Washington statute. So that created a lot of concern within the not-for-profit community about whether activities of nonprofits that were in quasi-endowments or sitting outside of endowments altogether, where those would be subject to tax or not. There was a bill that was introduced by the Department of Revenue on Monday, I believe, that created a broad-based deduction for investment income of nonprofits. So then we wouldn't have to go down this path of determining, like, does it sit in an endowment? Is it under the 5% threshold? Is it in a quasi-endowment? Does that qualify? Because these are terms that up until this point haven't been defined under Washington tax law. There's also a broad-based deduction for artistic and cultural organizations that's been around since, I think, 2016. And that's for entities that are doing artistic or cultural activities within their not-for-profit entity. One issue that they have, which may also create issues for hospitals that may have some investment activities held in a separate legal entity, is that the Washington B&O tax applies on a separate entity basis. So every legal entity that's doing business in the state is treated as a separate taxpayer. That creates some negative tax consequences from a taxpayer perspective, because when you have related entities that are doing business with each other, maybe providing management services or other accounting services. For federal tax, it's revenue to one entity, it's an expense to another, it all nets out on a consolidated or combined filing. From a Washington state perspective, the Washington DOR, I say, like, this is one of their top 3 issues that they go looking for, is intercompany payments, that taxpayers think like, well, this wasn't real revenue, this was more of a bookkeeping entry. And DOR says, not so fast. These are all separate taxpayers for Washington purposes. So for legal reasons, many nonprofits have isolated their investment activities in separate legal entities. And so when you're applying this 5% test, there's currently, for this 5% safe harbor, there's no mechanism for combining or considering the consolidated operations of a group of related entities. So if you separated out all your investment activities, even though it might be 5% of the entire organization's gross receipts, it's 100% of that particular legal entity's receipts, therefore it does not qualify for the safe harbor. So hopefully we see some more clarification. I did review a draft version of information released by the department that said you were going to be able to do this on an affiliated company basis. There's only one other area of Washington tax law where they have taxpayers do that, and it's not to their advantage. This would be to taxpayers' advantage. And they ended up not including that in the published guidance that they rolled out. So that was somewhat disappointing. There's also questions around, so Washington gross receipts tax, there is no deduction for expenses. So there's questions around, well, what about losses? Do I get to offset investment income with investment losses? Typically, you wouldn't be able to do that. But if you look to how brokers are required to report for B&O tax purposes, they are allowed to offset gains and losses, but there's some restrictions around, like they have to relate to the same account. It can only be done on a monthly basis, which is typically their filing frequency. I'm hoping that we see something closer to what we have for financial institutions, which is an annual offsetting of gains and losses. So you wouldn't be, if you have one really good month, I mean, if you just look at the market now, it could be like things are just roller coastering week to week. But if you have one really good month and a really bad month before that, that you'd be able to use those to offset each other and not have to pay on all the income in one month and they get no benefit for the losses in another. So there's one other component of the latest draft legislation, a carve out for collective investment vehicles, where if you have a group of entity or group of investors that have come together and formed a legal entity to hold funds, not do the investment management, that has to be done through a separate legal entity, but just to hold funds and invest them in passive investment activities in the market, that those would not be subject to tax. I should also clarify that this tax does not, the B&O tax does not apply to individuals because they're generally not considered engaged in business. So this should not affect your 401k plan investments, those types of passive investments, but would include investments of entities that are actively managing investments and that are not retirement accounts. I may have advanced a little too quickly. I'm on Washington capital gains tax now. So the Washington capital gains tax is a tax, I think the first year it kicked in was, I think, 2022, and maybe 2021. It's a 7% tax that applies on capital gains of individuals over a certain threshold amount. And I'm citing to some of these areas that aren't going to apply specifically to hospital or healthcare organizations, but they do affect how some highly compensated individuals that might work for those organizations are taxed. There's also been a fair amount of debate with some of these tax laws about whether there'll be carve-outs around healthcare compensation. And I think this also gives you an idea of like where we're headed as a state as far as tax policy goes and what might be on the horizon. Anyways, 7% tax on gains of individuals, capital gains that are, the starting point is what you recognize for long-term capital gains on your federal tax return. It only applies to, when it started, it was gains over 250,000. Now it's been indexed up to 270,000, along with inflation. There's a deduction for investments in real estate. So if you're selling a home, or if you have a business entity that's selling real estate and you're getting pass-through income that could potentially be subject to Washington capital gains tax, that the gains that you get associated with the real estate are not subject to tax. There's also a deduction for up to $100,000 of charitable contributions. I haven't gotten a lot of feedback from the not-for-profit community on whether they think that's a meaningful incentive to Washington donors. The ultimate tax savings would be about $7,000, $7,500, I guess, now that the deduction's at $108,000 per year and 7% rate. But it's at least something there to remind potential donors of that might be making contributions. Seattle payroll tax updates. So Seattle implemented a payroll expense tax. The first year that they had that was in 2021. This was an interesting way to get around not being able to have a tax on income, because our state constitution prohibits levying an income tax that is not at a uniform rate to all income levels within the state. So you basically can't have a progressive tax structure and have an income tax in Washington. You can only have one flat rate. And most income tax systems have at minimum like some type of standard deduction and then a graduated tiered system. So Seattle payroll expense tax says, well, this is actually going to be an excise tax on the business based on how much they pay to their employees. And it applies in the first year in 2021, it was to all compensation over $150,000 per year. And there's kind of two components that you have to consider here is your total Seattle payroll of the business, which has to be, in 2021, it was over $8 million. So if you had over $8 million of Seattle payroll expense and you had individuals that were compensated at $150,000 or more, then you get this, tax table where you figure out based on the size of the company and their Seattle payroll and the amount that I'm paying to folks between $150,000 and $400,000, and then over $400,000, there was a different rate that would apply. That tax is prohibited from being passed along to employees and was based on, there were some complications that we've worked with a fair number of our clients around, like remote work and determining where employees are even providing their services from, because you have to be primarily assigned to a Seattle location or, for all intents and purposes, performing 50% or more of your services from a location within Seattle in order for your payroll to potentially be subject to the tax. And there are two different ways that you can determine that. One is using this primarily assigned method, and then the other is an hours method where you allocate your time spent between Seattle and a work from home location or another branch location of your company. There is an exemption for nonprofit healthcare entities. Compensation that's under $400,000 was in the first year, and I think now it's $504,000. So any compensation paid below that amount, regardless of the entity's size, is not subject to the Seattle payroll expense tax. The Washington legislature this year considered a statewide payroll expense tax. Based on the information I got this morning, which I haven't had much time to go through yet, it didn't look to me like the legislature was going to move forward with the statewide payroll tax bills. So I think that's something we can maybe be aware of that might be a risk for future revenue raising purposes, but is not probably going to get past this legislative session. So then there was a special election in February of 2025 for Seattle residents. The city council then created an excess compensation tax to sit on top of the Seattle payroll expense tax, and that was for compensation in excess of $1 million paid to employees. This tax also was not contingent upon the amount of total Seattle payroll that the entity had. I said before there was kind of like this grid system where you'd looked at like, well, what's the size of our business's Seattle payroll, and then how many people fall into these different wage bands that determine our rate. For this new excess compensation or Seattle housing tax, it's just all entities that are paying compensation over $1 million to their employees would be subject to this tax. This is an extra 5% on top of the Seattle payroll expense tax, which is between 0.7 and 2.5%. So it's significant. All of this, I think, is happening kind of as a result of a political battle that's happening in Olympia and in some of these local jurisdictions. Our state usually is either the most regressive or second most regressive state tax system in the nation, which is kind of surprising given our general political leaning. The other states that we're usually like are right up there with us are like Texas, Florida, for most regressive, meaning highest tax burden on lower income populations. So I think they're trying to fix that with some of these new taxes, and whether they're going about that in the right way or not, and whether that's going to encourage future economic development and allow us to attract the same volume of talent to this area and business growth as we've seen in the past is obviously up for debate. But we're seeing that play out on a state level. We're seeing that play out on a local level when you look at like businesses that are choosing to either relocate or set up headquarters in Bellevue versus Seattle. Those cities are two that are right next to each other. But one of them has a payroll expense tax, the other one doesn't. But also hard to know how long that would last. There's also, for the excess compensation tax, I should mention this, there is no exemption for nonprofit healthcare entities. Taxability of grant proceeds. That I've had this slide for, I think, 2 years now. I feel like it might be becoming less relevant in the immediate future, unfortunately, as we see grant revenue from the NIH and other healthcare related government entities get cut. But regardless, Washington has a deduction for gifts and donations that are made where no significant goods or services are returned to the donor as a part of making the gift. Now, that's not specific to nonprofits, but it is definitely interpreted differently depending on, in my experience at least, when you're working with the DOR, and a for-profit company versus a nonprofit. There's Washington Rule WAC 45820-169, which speaks specifically to grant income received by nonprofits and other contributions. And they use an example where they say that there can be a report and like a system that exists where there's accountability for the spending as more of like a or as an auditing mechanism, where it's like, we're giving you this grant to fund operations in these specific areas of your business. And we're going to require you to submit a annual reconciliation showing how you're spending these monies to make sure that it applies with, or rather that it follows the agreement of the grant contract. So that's permitted. That's not considered a deliverable. However, there are other cases where it's like, if you're hired by the National Science Foundation to do a study of the health of a Washington river, and then you have to produce a report as a work product for receiving that grant. That brings into question, like, this is where it starts getting into an ambiguous area where it's like, well, was that really like, were you being hired to perform services and produce a report for the National Science Foundation, or were you given a grant by the organization for which you had no obligation to provide any goods or services in return? I had a nonprofit entity that was educational that I was working with who received NCAA grants. And the grant proceeds were based upon the number of games that the school played in every year. And they got significant bonuses depending on how far they made it in the NCAA basketball tournament in March. So the Department of Revenue in that case ended up deciding, and it wasn't enough money for the taxpayer to contest, they decided that that was actually payment for services, because the more games they played in, the more that promoted viewership in the NCAA tournament, which then the NCAA would be earning royalties from different television producers for. So that was one that I would have really have liked to have seen contested and appealed, but it just wasn't enough money to justify that effort. But it does fall into, with the exception of maybe NIH grants, which in my experience, there's nothing in the law that says those are treated differently, but in my professional experience, I haven't seen the Department of Revenue challenge those as deductible grants. But grants from other organizations, I have seen that. So that's something to be aware of. Another contentious area of Washington law is around initiation fees. I don't know the extent to which this would be an issue for healthcare related organizations, because I don't normally think of most of them as having like a membership model outside of like an HMO. But that doesn't mean that we wouldn't head that direction in the future. But there's been a lot of debate over the past 15 years in Washington about what constitutes it. Under that there's the same statute that says you can deduct gifts and donations. There's also membership fees within there. Membership fees and initiation fees. But as we covered before, like, you're not allowed to provide any goods or services in return for that fee, donation, grant, whatever it is. So when you join a country club, for instance, which is this Royal Oaks case, usually you have an option to buy like a social membership, and then you can upgrade to a golf membership. Some of these organizations have gyms, and you can be a fitness member. And so there's a question about, well, what portion of what you're paying to them in membership fees and potentially initiation fees is actually payment for services. So the Washington Department of Revenue has a like 10-page excise tax advisory on all these different methods for determining what portion of a membership fee is subject to B&O tax if you've got this like tiered system of membership. The same thing came up with initiation fees, and in this case, the Royal Oaks Country Club was prevailed against the department, which is kind of rare in recent Washington history, saying that even though they had graduated initiation fees, so if you joined as a social member, you would pay like $1,000 for your initiation fee, versus if you joined as a golf member, you would pay $5,000 for your initiation fee. And they said that incremental amount, the $4,000, was still a bona fide deductible initiation fee and not payment for services. That same logic doesn't apply to membership fees, but basically all of your initiation fees are deductible. So it was at the very least, if not, doesn't have like widespread application outside of like country club or social club industry. I will say it was nice to see a little bit more objectivity from the Washington state court system, at least objectivity from my perspective. Washington excise tax complications. So this is kind of a a la carte list of different issues that I've commonly run across working in the healthcare field in state and local tax. And this is kind of my personal checklist to bring up with new clients. Government payments. So there's two different deductions related to government payments in Washington that I commonly work with. One is for health or social welfare organizations, which there's a kind of long, complex statute around who's a health or social welfare organization. But if you meet that definition, then you're permitted to deduct amounts received from government payments. And that would include Medicare Advantage as well. So one of the areas where we help a lot of our clients is going through their revenue list and trying to parse between is this a government payment or not? And the Medicare Advantage oftentimes is one of the harder areas to identify government payments in. And it also includes things like TRICARE and other veteran programs that can sometimes go unnoticed. So it's important to be able to differentiate between those. For for-profit entities, there's a drugs delivered by infusion or injection deduction for government payments. So separating out that revenue and then determining whether it's a private payer and insurance or whether it's government subsidized is important. Contractual adjustments to patient revenue. This is a tough one for me because it's usually more of an accounting problem than it is a tax problem. But when you have contractual adjustments that are being made for services that are rendered, oftentimes those adjustments are being made months after the revenue's already been recognized for tax purposes. So figuring out ways to tie those back to originally paid tax and making sure that you're not overpaying based on what's actually received for payment. Identifying out-of-scope service and product lines. I feel like this one will become increasingly more relevant as we see telemedicine start to become more popular and more creative ways around delivering healthcare services. I normally think in a traditional sense, I've seen this play out, hospitals generally pay 1.5% B&O tax on all of their hospital service revenue. But if they have a pharmacy, for instance, generally pharmacy is going to be retail. And there's different exemptions for when you're selling, sales tax exemptions for when you're selling prescription drugs, or over-the-counter drugs delivered pursuant to a prescription also qualify, or no retail sales tax is charged to the customer, but you still pay retail B&O tax, which is a third of the rate of the service rate for medical services, which is 1.5% in Washington. I think as we also see telemedicine become more popular and other digital products and add-ons to medical services being used, I haven't seen any cases yet where those are separately sold to patients. They're just provided as a part of a healthcare service. You get access to your MyChart system online. And Thus far, that hasn't risen to a level of materiality where the department, at least from what I've heard, has come in and challenged whether that might make the medical service or component of that medical service actually like a digitally automated service, which is subject to sales tax in Washington. But the Department of Revenue has been very aggressive in other industries. My joke with clients is that like it's only a matter of time before they start coming after accountants because a digitally automated service in Washington subject to sales tax is a service delivered electronically that uses one or more pieces of software. And I'm like, God, that's like everything in today's economy. It's like I meet with my clients and I give them tax advice over Microsoft Teams. Like, I think technically that's a service delivered electronically that uses a piece of software. Fortunately, they haven't gone that far yet, but with a lot of companies and startups that are doing things that the Department of Revenue's never seen before, they are being very aggressive. So it will be interesting to see how that, as the healthcare delivery model evolves, how far behind the tax system will be in adjusting for that. Remote employees and state taxes. I have seen this play out for a few hospital systems that have started to hire technicians in different states. So not necessarily healthcare providers or primary care providers, but folks that help in supporting the delivery of those services. So where it used to be like, oh, we only have a hospital license in Washington, so that's where all our employees are. Well, now we're hiring some technical support folks to provide services remotely from locations outside of the state. What do we need to know? What do we need to think about for state tax purposes? And this is kind of my checklist of all the issues that you'd want to think about and consider when you have remote employees working in new jurisdictions. And this isn't specific to healthcare. So like sales tax nexus, for instance, probably sales tax is not a big concern for healthcare entities, even if they are providing some telemedicine services. But I think if you have this list covered, that really is pretty comprehensive from a state tax perspective for remote employees. Online education and training. This kind of highlights or touches on an issue that I alluded to before, which is where we're seeing more traditional services that were provided in person, moving more towards a digital platform, and the Department of Revenue looking for opportunities to reclassify those as retail services, not professional services, and then collect sales tax revenue at 10%. Or more, depending on where you are in Washington. We saw this play out a lot post-COVID, where you had several professional organizations that would give trainings and educational services in person. They're like, okay, COVID's here, so we can't do any business right now, so we're going to take this all digital. And most of the time when they were doing that, they started recording the sessions as well and offering them for playback. And then a few of them developed an app where you could access all of these trainings after you had participated. And that really then blurred this dividing line between like, well, what's a digitally automated service subject to sales tax? And what is a professional service that's just provided online primarily using human effort and should be taxed as a professional service? And Washington came out with some rules around like, well, it has to be provided live, it can't be recorded, there has to be an ability of the lecturer or educational instructor. They have to have the ability to interface and communicate with the students, similar to if you were in a live classroom. And if you meet those requirements, then it continues to be a professional service. I don't know the extent to which we'll see this start to creep into the healthcare field, where when we're investing more in like preventative medicine, I could easily see that like there's online videos or training or other services that are offered not primarily using human effort, but more digital. So something to like keep your eye on and think about as maybe your organization contemplates changing or evolving traditionally human service offering into something that's supported using software technology. '25 legislative updates. Okay, so what's happening right now? We've got 10 days left in the regular 105-day session. I expect that will stretch on past that date, but not sure how far. I summarized on 2 slides the significant House bills that I was tracking and then the Senate bills as well. Some of these are still alive and a part of I drafted this like end of last week, beginning of this week, and it's already, parts of it are obsolete. But I'll call those out. So the first one was business and occupation tax reform, having a B&O tax surcharge on specific revenue classifications. That is still alive and likely, and is like a cornerstone component of the latest legislative bills that were released this morning, the budgets rather. The intangible assets tax. There's a House bill associated with this and a Senate bill. It was getting a lot of support in the legislature, and what it was basically going to be is like a tax, like similar to a property tax, a tax on the value of financial intangibles owned by individuals. So it's not transaction-based. You don't have to be generating any income with those financial intangibles. You just have to own them. It's more or less a tax on your net worth. And that was, Governor Ferguson actually said that he would veto any budget, or at least that component of the budget, that came to him that included a wealth intangibles tax. So that was not included in the latest budget that I saw from this morning. Both the House and the Senate have bills for reforming property tax in Washington. There's pretty strict limitations about how fast property tax, which is levied by the county, but the state plays a big role in enforcement of the rules for property tax, how fast those property tax rises can happen. And both the House and the Senate had bills out which have now been combined to limit those or to decrease the limits on those changes going forward. So I would encourage you, if you want more details, you can look up this House bill, but I would just look up the latest legislative budget to see what the terms of that are. There's also, I'll go to the next slide while I make this comment. So here are the Senate bills that I highlighted. In addition to what's on this screen and the previous one, they're adding another, or proposing to add another tier to the Washington capital gains tax. It's a 2.9% additional tax on capital gains over $1 million. And that would be on top of the current 7% rate that exists. And then there's also Senate Bill 5814 and House Bill 2083 are expand the sales tax to custom computing services. Probably not a concern directly for any businesses in this room, but if that was passed, your healthcare systems might be consuming custom computing services that you traditionally haven't been charged sales tax on, which would be subject to sales tax if the new legislation's passed. There's a payroll tax, the payroll expense tax. I referenced that much earlier in the presentation. That's been actually dropped, so they're not considering the additional 5% on employers that are paying over $176,000 of compensation to individuals. And then the big one from the Senate bill is the first one on this list. I don't have a great description here. Repeals various tax exemptions. There's a legislative group called, they're referred to as JLARC, the Joint Legislative Audit and Review Committee. And they do different tax studies at different points as directed by the Washington State Legislature. And they identified 15 or 16 what they refer to as ineffective and obsolete tax incentives that they think should be eliminated in the state. So this bill would get rid of those various tax exemptions for different revenue lines, or what should I say, like revenue income categories for B&O tax. Part of the way that they conducted that study is there are several incentives that if you claim the tax exemption or incentive in Washington, you have to fill out this annual reporting survey that basically says, here's how much of a tax benefit our organization received, and here's how many new jobs this created, here's how many additional capital expenditures were associated with that work. Something that's meant to measure the economic impact and benefit to Washington residents, taxpayers, the state economy as a result of you receiving a tax benefit. And there were several areas where they said there's too few taxpayers receiving these incentives or utilizing the incentives, and too little of a economic, social impact in our state. So the Senate then decided that they were going to get rid of some of those. That's all I have. So I will open it up for questions. And if there aren't any, then you can go to lunch early. And you don't have to ask them in front of the group. Sometimes these are like, the questions can reveal sometimes sensitive information. So if you wanted to connect separately with me, my contact information is a part of this slide. Love to connect with you. Yeah, Kale, good to see you.
And apologies, I walked in a little bit late, so if you said anything, apologies, but I'm just wondering in general from what you're seeing from the Department of Labor, how aggressive they're being overall. And I ask that because, for instance, we've gone through reverse audits where we feel like we've overpaid, so we've gone and asked for refunds, but then that's triggered the Department of Revenue to audit us. So they come back and say, well, if you're going to do this, we're going to do that. And so I'm just wondering, how, just in general, aggressive they're being, just overall, I mean, for healthcare, but also other industries.
Increasingly aggressive every year. It's, from my perspective, which obviously is a biased one as a client service provider and taxpayer representative in a lot of these audits, but it feels less and less objective, and like the goal of an audit is to arrive at the best answer based on the tax law, which will always include some ambiguities. Like it's never going to be bright line test, crystal clear, how tax should apply to every transaction, every purchase, every customer interaction. And my experience has been that the Department of Revenue is more and more taking a position of like, if there's ambiguity, we are going to err on the side of assessing tax. And when we try to engage in respectful debate around that as a part of like the audit review process. A lot of the time the response that we get is like, well, we'll just have to agree to disagree on this. They'll like hear you out. The auditors are very polite. They'll hear your argument and they'll say, well, we're just gonna have to agree to disagree on this, and if you don't like it, you can appeal to court, which to me feels like not the right system, because going to court is so expensive. Like, you're talking legal fees probably of like a minimum of $50,000, probably closer on average to $100,000 to engage representation from an attorney. And then you're also talking about, like, if you go to the Board of Tax Appeals first, you're at least like waiting a year or two before you're going to get a decision. In some cases, closer to 3 years, because they are so backlogged with personal property tax valuation appeals. We don't have like a separate tax court for businesses. So I think the department knows all of this, is a long answer to the simple question. So they're like, well, a lot of taxpayers either can't afford to challenge us on this, or like it's not worth waiting for them on, with this uncertainty lingering over them the whole time. And if it's a sales tax issue, which is probably some of the most common ones that come up, they're like, well, a lot of the time it's sales tax issues for the seller of a service, and they're like, well, we'll just pass this along to our customers from now on. If you're making purchases as a consumer, like most healthcare organizations in Washington are doing, then it is a bigger issue. But oftentimes not one worth going to court over, especially when like the recurring nature of the types of items that you're purchasing, like it's always evolving, because, I mean, yeah, there's things like gauze, cast materials, like those probably, I mean, those, I guess, orthoplasts, and there is some cool technology happening in that area. So even that's evolving, but like there's some things that are never gonna change as far as the nature of products purchased. But like the ones that are in this gray area that we argue with the department over, oftentimes like, well, you know, this product might not even exist 5-10 years from now. It's gonna be some new iteration, so do we really wanna contest this with the department? So that's disappointing, in that like I would like for it to be more intelligent conversation and debate with the department around some of these issues. If there was an industry where they're more inclined to engage in those types of conversations, I think it is like with healthcare and nonprofits. So that works to the advantage of a lot of folks in this room. I will also say I've gone through like a fair number of, or represented clients in a fair number of local tax appeals as well. I find that the local jurisdictions are much easier to work with than the state is. And that they're like a city of Seattle audit, I do find, I personally feel like you get, their goal is to arrive at a more objective best answer, and not just to say, if there's any ambiguity and we believe that we could potentially support a position that this should be subject to tax, that's the position that we're going to take. Other questions? All right, I think then, Michael, do you want to come back up?
Great. How about we give another hand of applause here for that?